What if you could make investing super simplified and just putting money into 3 simple ETFs could yield you over $1 million with time? Now, in today's video, we're going to be looking at 3 perfect SPDR ETFs for retirement, really focusing on State Street, which we know is an ETF industry heavyweight, having over $1.2 trillion of investors' money across 100 plus different funds, which is kind of crazy. And they also do yield a very low expense ratio, some of them even running a 0.1%, which means that you're spending $10 for every 10,000 that you have invested. Now, of course, when it comes to SPDR, they are really the cornerstone of ETFs, having the SPY, which is the SPDR S&P 500 ETF, which was the first ETF launched back in 1993, which was, of course, the only and the first ETF of its kind, and really led the gateway to the ETF revolution, essentially, that we've seen with everything going in here. Now, of course, while you may assume that SPY was the ideal building block for portfolios, which it kind of is, it is not the best S&P fund that is out there. And of course, State Street has since then come up with some better funds because it does have a little bit of a higher expense ratio. And some of the funds actually have considerable expense ratio that is much lower. And even some funds outside of SPDR or SPDR, the State Street are at a zero fund, zero cost, which is kind of crazy to think. But beyond kind of the minor fees and expenses that we see, they are relatively cheap. When you start looking at mutual funds, some of those are 1%, some of those are 1.5%, which of course is 10x, if not higher, than we see with these ETFs. So let's go ahead and break down the ETFs that are in this 3 perfect SPDR ETF portfolio, starting with number 1, which is the SPDR S&P 500 ETF, which is the SPLG. Now this one, of course, this is a little bit different than the SPY, which was the original one. And the big reason for this, for all intensive purposes, this is a mirrored ETF. So it is simply tracking the index, what we see with the SPY. The big difference with this is the cost. Now, when you start getting into higher dollar amounts, when you start getting into the longevity of 20, 30, 40 years, this is where the difference comes in. The SPLG charges only a 0.02 annually, making it the cheapest ETF in the marketplace outside of those 0% that we're talking about. Now, of course, if you don't want to be just in the S&P 500, which is what we're looking at here, you can also do the SPM, which is the S&P 1500 composite ETF, which of course includes those mid cap and those small caps. So very similar if you're familiar with looking at like a VOO from Vanguard or looking at the VTI, which is the Vanguard Total Index. It is relatively they're very similar relative to what they track. Now, one, of course, is just focused right into that S&P 500. The other one is invested into those mid caps and small caps, which of course is the core holding. We talk about this a lot when we talk about our 3 fund portfolio, our 3 ETF portfolio, is having a core. So a core, essentially ETF in there, is what tracks the index itself. And of course, the perfect one, like we said, the SPLG, which is the SPDR portfolio S&P 500 ETF, is the one that is going to fundamentally be the core of this 3 perfect SPDR ETF portfolio. Now, second one we look at, and this is kind of questionable for me personally, is the SPDR portfolio aggregate bond ETF, the SPAB. Now, this, of course, is focused on bonds. Now, this is going to be relatively less important, I would say, if you're younger, let's say 20, 30, 40 years old. So this is the State Street version of essentially the iShare, the core US bond. So this tracks the same index as we see before. The thing with this one is when you look at this, the index is very, very heavy bond-wise into government securities, which is a big part of the ETF that we have here. Now, pretty much every SPDR index fixed income ETF, however, it targets a specific market instead of just the broad market again, which is the reason why some people don't like the buildup of the bonds. And of course, when it comes to bonds, it's a very low return. So looking at some of the returns that we've actually seen here, bonds usually returned about 1, 2, 3% when you start looking at bigger picture. When you start looking at, the 10, the 20, 30 years with these bonds, unfortunately, they do not yield the return that we really need to see. Even though they give us a ton of stability, the return, in my opinion, is not really there. Now, with that being said, looking at the perfect portfolio and breaking it up, so let's say you're in, your 20s and essentially you're looking at really 2 different ETFs, possibly having some bonds in there at a very, very small percent. Now, again, a lot of people say that there shouldn't be any bonds at all at that point. But when you start getting to retirement and getting closer to retirement, you can shift the percentages essentially that you're investing in to really have a lot more mitigation, essentially risk mitigation over time, because of course you do want to protect the assets that you've accumulated. And of course, once you get to that much larger nest egg, that is where the final ETF comes in, which is the SPDR S&P Dividend ETF, or the SDY, which is the dividend ETF. Now this, of course, there's nothing that really makes the portfolio complete than a dividend ETF. This is the reason why we're very, very focused in. Of course, you're not going to see the big ups with this. You're not going to see the big downs. However, you're going to see, number one, growth. Number two, you're going to see income. Not as exciting as we see with our tech stocks and our growth stocks, but overall, you're looking for long-term capital growth and long-term capital gains while producing a dividend, which is the reason. Now, of course, this is a very solid one entirely in the US markets. Now, me personally, I do not invest anything internationally. I do not invest anything outside of the United States. Everything that I have and every single ETF that I have is entirely in the US markets. Now, we know the US markets make up about 50% of the world marketplace, but when you start looking at the breakout of the performance of the US market, even over the past 30 years, there has been 7 years that the international markets have outperformed the US markets. However, that didn't mean that the US markets didn't still perform and didn't still perform well. We just had times where the international markets performed a little bit better. And again, for me personally, knowing what I'm investing in, what companies outside of the United States, what countries, I would rather focus all of my entirety into the United States. And I know, of course, when you look at Warren Buffett, he says the exact same. Everything should be American companies, should be in the United States. And I know right now with technology and everything else, it kind of crosses a world global index where we have a lot of even US-based companies that are essentially, working abroad for everything they do. We have the exact same where a lot of companies that are international companies are in the United States, and so on and so forth. But looking at this ETF, the SDY, it is required to have 20 years of consecutive dividend increases. That is right. This is the very big, again, this is going to be the dividend ETF that we're carrying there. Well, the dividend yield is able to increase the yield by far over what that S&P 500 has. Dividend yield and the growth combination. So not only the dividend yield, but the dividend growth going up, as well as the growth of the stocks held within there, is not very uncommon to an ETF in the marketplace, but it has mixed results. So overall, when you look at the inclusion of the mid caps and the small caps that are dividend payers, not a huge return. Large caps usually pay a lot better, but however, looking at the big picture, so we have our S&P in there, which of course is going to track that S&P 500, tracking that index with a really big focus on those 500 companies. When you start breaking it down a little bit further, you are really, again, risk mitigation with the bond market, essentially, that you're putting money into. And we know times of higher inflation, bonds do a lot better. Then we see, the money kind of flows into bonds. When we have high inflation, the money comes out of bonds because the bonds are not paying as much and goes back into the market, cryptocurrency, REITs, other places to really build it out. But then, of course, the dividend ETFs, a lot of people are focused on the money and the actual income generation. So the big thing with this is when you're getting ready to retire, and this is something to definitely note, is a lot of money goes into some of these good dividend bonds, again, looking for a higher yield because you're at the point where you're supplementing income, and essentially a lot of that income is going to come from the dividend income that we see with these. Also, not only getting the appreciation aspect, but you're also getting a regular paycheck with these. All right, guys, so that is going to do it for the video, the 3 perfect SPDR ETFs for retirement. Let me know in the comments what you guys think, and as always, thank you guys for watching.